Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
When a big investor decides to sell, markets can move sharply, and some assets are particularly vulnerable, with ownership concentrated amongst a few large holders.
Today, we look at what happens when the biggest whales decide to dump their stocks, bonds, or gold. And in today's dumb question of the week, how does a stock exchange set a price if there's a buyer for every seller? All right, let's get into it. So I think it's fair to say, Roman, that neither of us is a whale. We can't move markets. But there are some investors who are so big and control so much of an asset class that maybe they can, if they decide to sell rapidly and at size. Now we're going to talk through, I think, 7 different asset classes and how there are whales which could make a splash. But I think we need to caveat it right at the start that a lot of this would be a kind of black swan event, wouldn't it? We don't typically see big investors dump huge amounts of holdings at once because it moves the price, which is bad for the rest of their holdings.
Yeah, it's a difficult situation. If you're a holder, a major holder of an asset, then you're kind of destroying your own holdings when you dump it onto the market. So really, if you can do it quietly in dribs and drabs, it's much better. So this is why for a long time people were talking about dark markets where you don't know who's selling. But look, if there's a huge amount of selling orders appearing on the market, they're going to work it out. Market makers are going to potentially drop prices very considerably to make the best of it.
Now, the idea for today's topic really came about because of quite a lot of speculation and rumours in the financial press over the last month about the technicalities of how the US government might account for its gold reserves. Now, the US Treasury is the largest gold holder in the world. It's got more than 8,000 metric tons, which at market prices would be around $750 billion worth. Now, that's a whale. There's no doubt that's a whale. But weirdly, because of an accident of accounting history, America doesn't recognize the full value of its gold on the Treasury books, does it?
Yeah, that's right. So in May of 1972, the US adjusted the price that it was using for valuing gold from $35 an ounce to $38, and then in February 1973 to $42.22, so $42. And it's been there ever since 1972. So in theory, yeah, there's a massive undervaluation of gold held by the US government.
Well, not just in theory, right? In reality, it's holding that huge stash of gold from Fort Knox and other places on its balance sheet for just $11 billion, not this $750 billion. Now, you can see when they're struggling for money, they've got this huge deficit. They're looking at that gold going, surely we can just change the number in the spreadsheet.
But you've got to think about the consequences on what will happen to the money supply and what will happen to the price of gold. Because if the US government dumps a huge amount of gold onto the market, that's going to massively affect the gold price. And of course, if they create lots of dollars, that could potentially be quite inflationary. So really, it's a question of not rocking the boat. Now, they can make small adjustments, but suddenly saying, OK, instead of $42 an ounce, we're going to go to the price today. Well, I think that would be very destabilizing.
And the price today is more like $3,000.
Yeah, quite a jump.
But interestingly, when I looked into this, it seems that they wouldn't actually have to sell their gold reserves to raise some cash. Unlike in most countries, the US's gold reserves are held by the government, by the Treasury, not by the central bank. And what happens is the Fed holds the gold on behalf of the Treasury and credits the governments with dollars in return. So if the US repegged its gold levels to market prices today, presumably the Fed could just print money and hand it over to the Treasury. But it would just be a one-off boost of, 700 odd billion, which is not nothing, sure. But in the scale of a $36 trillion national debt, it doesn't really touch the sides, does it?
Yes, I think if you did do this, the question is, what problem are you trying to address? Is the problem that you've got a large amount of outstanding debt? And is this going to fix the problem? Well, only temporarily, because if you've got a big fiscal deficit, then the debt's just going to grow again. And you've already revalued your reserves, which you can only do once. So I think the question would be, why would you do it? And then the second question would be, what would be the macroeconomic consequences, which I think would be quite inflationary. So I think it's a kind of crazy idea. This is unlikely to happen, but who knows? Under this presidency, everything's on the table.
It's interesting you say this could only happen once, because I think if you get into the habit of marking to market, you have to keep marking to market. And then what if we had a crash in the value of gold? Because, it has had this massive bull run. What if it halved in value next year? Presumably the Treasury then has to find 300 billion to give it back to the Fed.
Yeah, that's the trouble of mark to market, which is that, it could go both ways.
But in terms of the price of gold, this kind of accounting trick, I guess, wouldn't really move the price of gold because you're not selling it on the open market. Although there are some people saying that the US just has too much gold and should sell it down. One of those people being Stephen Myron, who is Trump's nominee to lead the White House Council of Economic Advisors. Now, he floated the idea of selling this stash of gold and basically getting dollars in return. And what he wanted to do was then exchange those dollars for foreign currencies, which could help strengthen those currencies and weaken the dollar and all this stuff, getting into the geopolitics of dollar strength. But that's the kind of situation where if the US did decide, we don't need this much gold anymore, we're going to sell it. Even if they only started with a small nugget of gold, I think the signal that would send to gold markets would be bearish.
Yeah, so this is like a Plaza Accord, but a preemptive one, which was the agreement in the 1980s to devalue the dollar. But of course, that was done in collaboration with trade partners, and it was very successful at the time.
But do you think the market would panic, like the gold market would panic, if they saw the US even just dipping its toe into the water of selling gold?
Well, given the size of its holdings, I think that people would panic. And I think it probably would affect the price of gold. Because even if it's not going to be selling stuff, it's a psychological impact, but also the message it sends to the market, which is that, okay, we're going to inject lots of cash into the economy and it's due to an accounting trick. I don't think it would wear well with markets.
They are by far the biggest whale in the gold market. So as we mentioned, the federal government in America has around 8,100 metric tons of gold. And if you look down the list, there's a big jump down to the next holders. So China has just over 2,000 tons. Switzerland has 1,000. Some of the countries in Europe have just over 2,000. There's a huge difference.
But you can kind of see why they want to swap things out for things which generate an income. Because gold obviously doesn't generate an income, but if they bought foreign bonds, that would generate an income in those foreign currencies. So the US could build up its foreign currency reserves, which it could then use to manipulate what happens to the US dollar.
But we should say that, at least at the present time, administration officials are kind of briefing that this isn't something being seriously considered. Don't panic.
Yeah, I think the point here is also that the market can only absorb so much new supply of gold, and it can only absorb so much new supply of crazy. And I think at the moment, we're running this spigot of crazy quite hard.
Do you think it would be full-blown crazy, though? It's just an asset on their balance sheet. They can sell it if they want to.
Yeah, you can do whatever you want.
Britain, we sold our gold reserves, didn't we? Crashed the market, sold them really cheaply.
Yeah, and that wasn't great for us, it's got to be said.
But as we know, gold is old news. There's a new asset. It's a digital gold these days. And here, I'm talking about Bitcoin. And there's a similar kind of phenomenon in Bitcoin where there is one enormous whale. Now, the creator of Bitcoin, Satoshi Nakamoto, who programmed the blockchain back in 2009, at the time, he mined a lot of the initial supply of Bitcoin. And those coins that were mined are still sitting untouched in those original wallets. Now, it's hard to gauge exactly how much Bitcoin is linked to Satoshi, because it's spread over something like 20,000 different wallet addresses. But as far as I can see, the best estimates put it in the region of 600,000 to 1.1 million Bitcoin, which would be worth, something like $100 billion at the current Bitcoin price, and would make him the 15th richest person in the world by my looking at Forbes this morning. This currency has just sat there for, 15 years now? If those wallets suddenly started to make transactions, presumably the market would panic that you've got $100 billion of Bitcoin about to come online.
Yeah, that's a whale. And I think that could really move the price of Bitcoin. And look, that's the problem with Bitcoin. Although it is transparent in the sense that you can see who owns what with the blockchain, if you do get such large holdings by a small group of investors, then yeah, who knows what they're going to do. We don't even know who Satoshi Nakamoto is, or if they're a real person or a group of people. So if it was a bad actor, yeah, that could be a huge problem.
I don't know if it matters if he's a bad actor. There's been so much speculation about the identity of who Satoshi could have been. Perhaps they're no longer with us, and therefore these wallets can never be accessed, and that money's just been burned effectively.
But it is a case that sometimes these dormant wallets do come back to life. It has happened recently, hasn't it?
I think the biggest one happened in May last year when there was a wallet that had been inactive for 11 years. People, I guess, assumed the keys had been lost or the person had died or whatever. But then it suddenly moved 1,000 Bitcoins in one go, which was worth over $60 million at the time. And there's been other examples. I think in September last year, there was a wallet from the Satoshi era, if you like, even though it wasn't directly a Satoshi wallet, supposedly. That had been dormant for 15 years, suddenly woke up and moved 250 Bitcoin, which were mined in 2009. So these things can happen. Maybe Satoshi isn't dead and he's just been sitting there waiting for the price to get to wherever, and then he's just going to sell. And it's the ultimate long-running pump and dump.
Yeah, this parrot's not dead, it's just resting. But look, there's a longer-term issue here, which is cryptography. And if we do get quantum computers, then a lot of the encryption which creates the security around Bitcoin may be hackable, in the sense that if you have a certain type of transaction, you can actually hack it so that you can work out someone's private key. But there are quantum-resistant addresses, so it really depends on the type of key you've got. If you've got a pay-to-public key, which is the way people used to do stuff back in the day, that is hackable.
And presumably these wallets linked to Satoshi with a ridiculous amount of money in them will be hacked if they're not moved to quantum-resistant addresses. And if Satoshi is dead, let's speculate, then they won't be moved, will they? And they will be hacked, and then you'll have $100 billion worth of Bitcoin at current rates suddenly appearing on the market.
Which maybe isn't a bad thing. It would free up the cash, but obviously it depends on who hacks the wallet. You know, what are they going to do with the money and who's going to own it? Presumably the company that's created the quantum computer, which itself might pay for the investment.
But isn't it the case that whoever gets their hands on it, it's a supply shock, a huge supply shock? Just the potential that this Bitcoin could be sold down.
But Bitcoin is just like any other asset, which is that if you flood the market, then yeah, the price is going to crash. And this isn't something that people tend to think about with Bitcoin. Price goes up. You don't think about catastrophic crashes. You just think about huge volatility and eventual recovery.
Well, because the thing that always gets trotted out is that the supply of Bitcoin is capped at 21 million coins, right? But along that road to 21 million, you could get sudden supply shocks if this million that's been locked away suddenly comes online.
Yeah, and I think that would be the really awful black swan event for cryptocurrency. And if it did happen, then I think the shock would certainly scar lots of people, because the assumption is that it is kind of safe in the sense that it eventually goes back up again. And it probably would go back up again. But that kind of fall remains in people's memories.
I think there are lots of markets where people worry about a sudden supply shock, like a big whale suddenly dumping all of their holdings on the market. And the one that has been speculated about more than any other, I would say, over the last decade is the fact that China owns a lot of US treasuries. What if China suddenly, for some reason, decided to sell all its US treasuries? And at last count, it has something like $800 billion worth.
Now, a good point to make here is that, again, it's going to hurt China if it does that. So it would have to be a very brave decision on their part to have a monetary loss. Because firstly, I think it would be a problem selling it. You know, which market makers in the US would absorb that sale? And would the US government step in? And have they already prepared for this kind of eventuality? which effectively would stop the sale. I wouldn't be surprised if that was the case, because this is a strategic risk for the United States. If foreigners do dump their debt, and particularly ones which are not particularly friendly with the US, then it could destabilise their entire economy. And that's not something which they'd allow, I don't think. And it's not as if we can't see this data. This is published every month or so. It's called the TIC system, the Treasury International Capital System, and it's fairly transparent, not completely.
I seem to remember, and I might be wrong on this, but I seem to remember that a lot of Chinese holdings and transactions show up as Belgium. Because they hold the treasuries there or something. I've no idea.
The Cayman Islands, as of November 2024, held about 400 billion. Now that's probably hedge funds, we don't really know.
If you look at the total holdings by foreign governments of US treasuries, it's around 8 trillion, which is something like 23% of the total US debt. Now, China isn't actually the biggest foreign holder. Japan is the biggest holder of treasuries, with over $1 trillion actually, 1.1 trillion as of the end of last year. China is the second biggest, with around 750 to 800 billion. The interesting thing is that China has run down its holding of treasuries over time. It peaked in the years between 2012 and 2016, and at that point it had over $1.3 trillion of US debt. And it's just been gradually running that down over time, certainly not dumping it on the market.
Now, one conspiracy theory I've heard is that they're saying, well, if we have our money parked in US treasuries, then if we do something which the US doesn't like, they could confiscate our assets. So some people think this is a build-up to a potential invasion of Taiwan.
I think that is a real consideration for China. It's been diversifying its holdings. You can just see that from the data it's publishing. It's particularly been adding gold in there and some other foreign currencies. You saw that it was running down its treasury holdings over time, but it's really accelerated that since 2022 and the Russian invasion of Ukraine.
But that's the theory. They see what happened to Russia and what happened to its assets, and they think, well, do we want assets parked in US dollars? I think the difficulty for them is that if they do export things to the United States, they end up with dollars. But then the question is, what do they do with the dollars? Do they use it to buy assets in the United States? Well, no, because that's a strategic risk, potentially, depending on what they do in the future. Do they use it to buy assets elsewhere in the world? Well, they're not quite as safe as US dollars.
They could give some of it to the Middle East in exchange for oil.
And I think they're already doing that. So it's difficult to know what they're going to be able to do, given their huge trade surplus. But who knows, perhaps that's going to fall as well.
Well, historically, they've been buying treasuries, right? They're safe. They pay a reasonable income now. That's the obvious move. But then the downside is China ties itself to the US.
But look, the fact that the amount of treasuries they hold has fallen by about 30% over the last 4 years, 5 years, that suggests that they're already deciding to move away from that as a matter of policy. But what they're not doing is dumping treasuries onto the market, at least not yet.
But they're a net seller in a way, at the same time as the Fed is a net seller in a way. Not actively, but, it's letting its treasury holdings mature. I don't think it's a surprise that yields have been rising.
But look, this is a market that trades $500 billion a day, so it's very, very liquid. It can absorb a lot of selling and buying. And I think there's still a huge demand for US treasuries. Structural buyers exist, companies that have to buy them. And because it forms a lubricant for all market transactions, because it's such a safe asset, I think that structural demand is going to stay in place. Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and the lowest FX fees I could find on the market. Looking to keep things simple? You can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Customers with Invest accounts can also benefit from the Trading 212 card, which has no FX fees, true interbank rates, and offers 0.5% cash back on all transactions up to £20 per month. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1, and use the promo code RAMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You're responsible for all investment and rebalancing decisions. Free shares can be fractional. 212 cards are issued by Paynetics, which provide all payment services. Trading 212 provides customer support and user interface. Terms and fees apply.
Okay, so we've talked about the biggest whales in gold, Bitcoin, and treasuries. Let's move on to stocks. Are there any whales in stocks, really? Obviously, there are in individual stocks because you might have a majority shareholder, but in the market as a whole?
Now, the one which doesn't matter, which people are always talking about, would be Vanguard and BlackRock, because if you've got passive funds, they're going to own a bit of every stock in the world, 2%, 3% of every stock. And the reason why that doesn't matter is that those index funds own everything, a little bit of everything. So if they were sold, it wouldn't affect just one stock. It wouldn't be concentrated in one stock, the effect.
And I guess they're also representative of a lot of different people, right? It's not like there's someone sitting there suddenly saying, we need to sell everything. No one at BlackRock or Vanguard is saying that. They're just reflecting flows into their funds.
But there are large funds which have discretion over which single stocks they can sell. I'm thinking here about some huge sovereign wealth funds like Norway. And of course, another one, which is quite surprising, is the Bank of Japan.
Yeah, that's a whale in the Japanese equity market. So as of last count, I believe its equity holdings are around 70 trillion yen, which is 7% of all listed Japanese stocks.
Yeah, it's risky being a whale in Japan, as we know. But
that might be the best joke you ever made, Roman.
But if you don't want to end up as sushi, you wouldn't sell all of your own stocks because obviously the Bank of Japan won't want that kind of instability. So again, it's got this really difficult situation. If you own your own government bonds, those eventually mature. It's not a problem. If you own your own equity, well, those are perpetual instruments, so they won't mature. So the only way to get rid of them and run down your balance sheet is to sell them. And you have to do that very, very carefully.
And why is the Bank of Japan owning all these Japanese stocks in the first place? It's pretty unconventional for a central bank to buy its equity market.
Yeah, they took unconventional to new extremes in Japan. So with their quantitative easing program, they called it the QQE, quantitative and qualitative, which is even more unpronounceable. But they decided that they were going to buy Japanese equities, and that was going to be something that they'd use to stimulate the Japanese economy, which probably it did. But now they're left with this situation where they've got to reverse what they did. And that's going to be very painful, I think, and very slow, hopefully.
I think they started back in December 2010 buying these ETFs, and then quite rapidly became the biggest holder of Japanese stocks. Interestingly, they have made a big profit on those purchases. So of the market value of 70 trillion, which its stock holdings currently have, around 34 trillion of that is unrealized gains.
So it has been very profitable for the bank to do that. But of course, at some point, it's got to make a decision about what to do. And there are some creative solutions that people have come up with. The one I liked best was to give young people a gift of these stocks so that they get share ownership, and presumably they're not going to sell these things until they grow up. So it's kind of nice because it gives the next generation a boost.
Or I guess you could transfer it into the government and create a kind of sovereign wealth fund under democratic control, not just the central bank.
It really depends if you trust the government with that kind of responsibility over the stock market.
But the point is, neither of those things unwinds the QE, right? That's just saying, well, let's lock in the QE forever. We've printed the money. Let's not unprint it.
Yeah, the job's done, and they've got a debt to GDP of 250%, and it's not going down anytime soon.
They have been selling down some stocks. They sold down a load of bank holdings they had, but it's a lot smaller in value than these broad ETFs. And it is clear that moves they make can negatively impact the stock market. So the Bank of Japan actually changed its rules for purchasing ETFs in 2021. Before that, it had been buying the Nikkei 225, which you hate, Romin.
Absolutely. Yeah, it's a price-weighted index, which is an abomination.
And it's quite narrow, and it's heavily weighted to the biggest Japanese stocks. Then in 2021, they changed and said we're going to buy the broad topics index, which is more like the S&P 500. That change did have a big effect. So the Nikkei fell 6% across the next 4 sessions. And some of the biggest companies, like Fast Retailing, which owns Uniqlo and is the biggest stock in that index, fell 14%. So these little changes in rules and what they were buying had a big impact. Imagine if they started selling it on size.
The other thing which people don't really think about is the governance change, which effectively has come into place because of the Bank of Japan holdings. Because if you think about the Bank of Japan, they own lots of shares effectively and directly through these ETFs. So that means that people can't vote because their shares have been given up to the Bank of Japan. They can't vote on corporate governance. So in a way, this has diluted corporate governance. And one of the ways they chose the ETFs that they bought was to improve corporate governance. So I think that's one of the problems with this huge central bank ownership. And the sooner it gets unwound, the better. But look, it's going to be such a difficult thing to do.
Communism by the back door, isn't it, Roman?
That must be why. It is kind of anti-capitalist in the sense that you lose the ability to have that corporate governance.
So I guess it's fair to say the Bank of Japan is a whale and it's playing in quite a small pool there in the Japanese equity market. If we turn our attention now to America, I don't think there are these problems with the broad US market. It's just too big, really, for a whale to capture it. But if you go down to specific stocks, and even some of the big stocks, there might be concentration problems there. So let's take an example. Let's look at Berkshire Hathaway and Warren Buffett, everyone's favourite stock investor. So he's been selling down his stake in Berkshire, but he still owns around 15% of the company and has more than 30% of the voting interest because there's this dual share structure. Now, you're probably aware he's pretty old. So he's 94 and worth something like $150 billion, which is almost entirely in Berkshire Hathaway stock. The question is what happens when he does pass away?
Now, what he's famous for is that he said he's going to give away his wealth. But that's not easy to do when you've got so much wealth. So what he's done is to delegate the decision about what is sold and when to his children.
And like you say, it's focused on philanthropy and charitable giving. But the question is, are you going to sell down the Berkshire stock and give these charities money? Or are you going to give them the stock? And I believe he's already giving away about 5% per year of his holdings, though Berkshire's stock is going up by more than 5% a year. So it's not actually giving away much in absolute terms yet. And the other challenge is that his children are all in their 70s, right? So they probably won't get rid of it all in their lifetimes. And what makes it so intriguing is that Berkshire Hathaway is a very unusual company. So it's one of the last living conglomerates, you would say, where it's got its fingers in loads of pies, which corporate strategists hate now. They want the company to be just focused on one thing and be really good at that. And if it's split across all these domains, split it up into different companies. And obviously, Buffett's always resisted that. But when he's not there to resist it, and Charlie Munger's already gone as well, I think you'll see a lot of investment bankers swooping on who can muster control of Berkshire.
And activist investors, companies like Elliott, would probably take an interest in splitting up Berkshire. And in a way, it's a shame. You've seen this guy build up this business. You've seen it be incredibly successful. And it worked. It just worked really well for many investors for a long period of time. So I think the equity markets will be a bit of a darker place if that happens. But I think you're right. I think that is the direction of motion. I think that's the way we're going to go. It probably will get split up. And it'll just become a footnote in history.
I think Buffett is well aware that succession planning is important. He's chosen his CEO to be. He's set in place this trust system with his children and given them a task of what to do with his holding. But the conventional wisdom would still be that the day after he dies, Berkshire stock would crash, right? Oh no, the genius who built this company has now gone. Interestingly, though, Buffett thinks the opposite will happen. He has said, and I quote, "The stock will go up tomorrow after his death." And I think this is because of this phenomenon where the market might believe that there's untapped value there if we just throw out some of Warren's sort of old-fashioned rules.
Yeah, selling See's candies is going to be massively wealth creating.
I mean, you joke, but there is a genuine question of whether a conglomerate makes its holdings greater than the sum of its parts, or actually less than the sum of its parts, if you're sort of holding on to weaker companies just because you kind of like them as part of your portfolio.
Yeah, I use these candies as a joke, and it was a kind of weird holding, right, when they first started out. But I guess what you've got with a conglomerate is the ability to take cash out of one business and then funnel it into another. And if they do exist in different sectors, that way you can create a sustainable business which weathers different economic situations. You know, sometimes a railroad company will do well, sometimes the insurance company will do well, and they can all prop each other up. But the question is whether they'll do better alone. And I think that's not an easy question to answer.
Yeah, there's pros and cons, isn't it? I mean, the major con really is once you get to the size of Berkshire, you have to find investments that are of such scale to move the needle. That's really hard to do, right? You can't really beat the index at that point, whereas smaller companies might be able to.
Yeah, when you become the index, it's hard to beat it.
But how would you feel, seriously? Would you be nervous as a Berkshire shareholder now, knowing that, Warren can go at any time, really?
Yeah, I'm not convinced that other people are going to have the secret sauce. And frankly, he hasn't had the secret sauce for a long time. So, yeah, I mean, I was never really a buyer of Berkshire Hathaway. Because by the time I knew about it, it was kind of too late. He'd already got his big returns.
But he is maybe the greatest individual investing whale there's ever been. And he concentrated largely in a few sectors, didn't he? Energy being one of them. He's had mining companies and oil companies. Even now, he's still building up stakes in oil companies. But in terms of the oil market, there is a whale there, and it sits in the Middle East.
Yeah, so here we're thinking about Saudi Arabia, which has just got unbelievable reserves and still has unbelievably large reserves. And it is the largest exporter of crude oil in the world, even now, although the US has taken the mantle of largest producer.
What I think's a bit unique about Saudi oil is that they can get it out of the ground extraordinarily cheaply. So there's a concept in the oil world of break-even prices. And the idea is that Saudi can get its oil out of the ground and deliver it profitably for just $10 a barrel, which is not true of other producers.
In particular, the US. So when it was the case that Saudi wanted to squeeze shale producers out of the market, in order to do that, they increased their production to push down the price, hoping it would reduce US production by making some of these companies non-viable and putting them out of business in the US.
Yeah, that was back in 2014, I think. They started a price war, drove the oil price right down into the $20 region. And it did bankrupt a load of shale producers, I believe, in the US. But then when the oil price was allowed to rise again, they rose from the grave. And yeah, the US went on to become the biggest producer in the world. But there was also technological innovation there, I believe, in shale oil, where its break-even price went from around $70 to something more like $30, $35, depending on the region of America.
So that was a plan that backfired quite badly. But look, I think it's still the case that Saudi is a massive whale in this market. Really, they do hold the keys to the oil price. Maybe not unilaterally, but they can certainly affect it at the margin.
And obviously they are part of the OPEC cartel. They kind of lead that cartel in a way, which has evolved maybe into OPEC Plus with Russia. But it is a diverse group of countries, and they don't always agree. They targeted supply cuts to try and boost the oil price over the last few years. And it hasn't been that successful because some of the countries who have got budget constraints and are struggling have kind of worked around it and ignored the agreed supply cuts.
And an interesting development is that President Trump is trying to reduce US inflation. So he's asked them to produce more oil in order to get the price down for energy.
Which they're kind of resisting at the moment. But Saudi is in a very different position, I think, now to where it was in 2014. So we talked about the break-even price of oil, and that's still cheap. It can get it out of the ground and sell it cheaply. But it knows the end of the oil world is coming, and it is making huge investments through its sovereign wealth fund and in the country itself. And to balance the national books and allow it to do all this investment, it really needs an oil price approaching $100 a barrel. So the IMF estimated in 2024 that Saudi needs an oil price of $96.20 to avoid running a budget deficit.
Yeah, it's interesting. It's very difficult, I think, for them to move away from oil as a source of revenue for the country. Because the question then is, what resources do they have?
Well, that's why they're buying lots of companies, right, overseas and investing in tech actually a lot. But you're right that still now 75% of Saudi's fiscal revenue comes from oil.
And there's sovereign wealth funds from Saudi and from other commodity-rich countries like Norway. Those are now getting very influential in terms of the things which they own and the amounts which they own, which are often quite staggering. So what we've actually seen is moving from commodity whale to financial asset whale. And that itself is quite risky as well, I think.
It's got to do it, though. It can't just rely on oil and then suddenly realise the world doesn't want it anymore. Did you see about this city they were going to build, like just a line?
Neom, yeah, that was...
A line through the desert.
What was that?
I think they've abandoned that now, have they?
I think so. I haven't seen many news articles about it. I remember when I first saw the ads for it, I thought, this can't be right. This is just some kind of made-up thing.
I mean, it presumably started as a pun when they said, let's just draw a line in the sand. And then it's become a strategy. But talking of land, our final whale, come back to the US government. The federal government owns around 640 million acres of American land, which is about 28% of the land mass. We think about whales in the sea, but that's the biggest whale on land, I would say.
So if you look at a map of population in the United States, there are lots of people on the edges, on the East Coast, the West Coast, and then you've got the bit in the middle. And a lot of this land is the bit in the middle. And I'm sorry for all of those people listening in that bit in the middle. I've got friends who are from Minnesota. They call it flyover land. But there's a lot of demand to use that land for exploitation and for getting mineral resources.
You see a lot of commentary now, I think, coming from the right wing in America saying, we're not making good use of this land. We've got a bit of a housing crisis, especially in certain parts of the country. We should privatize large parts of land, allow the cities to grow. Well, fair enough, really. But like you say, a lot of the federally owned land is not particularly near cities. Although there are some exceptions. In Nevada, more than 80% of the land is actually controlled by the government. And Las Vegas could really do with new houses, so maybe they'll do something there. Even in California, I think 45% of the land is controlled by the government. But that's a lot of national parks. Do you really want to just start building on those? Or drilling in the hope of finding minerals?
And again, this is a one-off, right? If you sell it, you can only sell it once. And then the question is, what happens to it? And why are you selling it? What are you going to do with the resources which you generate?
But I guess there would be some macro consequences. Could they stabilize house prices or drive them down? Seems unlikely you can ramp up supply quickly enough to do that. But I know that places like Austin in Texas have successfully combated rising prices by ramping up supply quickly.
So would this be the US equivalent of Milton Keynes?
Yeah, they'd be living the dream. Although I would hate to see how Americans cope with that roundabout system. It's hard enough for us Brits.
It's funny, Laura and I like the big MK.
So just to wrap up then, we've covered 7 different whales here across commodities and gold, land, stocks, bonds, all the big asset markets in the world really. But these seem like quite extreme black swans to expect them to suddenly make huge moves and ruin the market for everyone.
Yeah, most of the time you can ignore these whales if you are diversified. But I think there is a slightly more sinister version of this, which is that many people are effectively in the same trade, which is the Magnificent Seven. So whether you buy a global index fund or a NASDAQ tracker or an S&P tracker, you'll end up owning those companies. It's not just tech bros that own Mag 7. And if there's a reversal of risk appetite or this narrative starts to wobble, as we saw with DeepSeek, we saw how brutal the sell-off can be because of the concentration.
So you're less worried about a whale and more about this enormous school of fish that's heading in the same direction. And if they get spooked, they could all start swimming in the other direction.
Yeah, whether it's a shoal or a whale, it causes the same problem. If you're worried about concentration risk, or you want to discuss potential whales and to learn how it could affect your investments, then join our community. You can learn about that by going to our website, pensioncraft.com/membership.
Okay, today's dumb question of the week is, how does a stock exchange set a price if there's a buyer for every seller?
Now, this is a question I'm often asked, and it does seem illogical that if there is a buyer for every seller, which there is by definition, certainly in the secondary market, then why does the price change? Now, the thing to understand is it's true the number of buyers and sellers has to be equal eventually, but you do get temporary periods of disequilibrium when there are more buyers than sellers. Now, the only way to redress that balance is for the price of the stock to rise if it is a stock. Now, this is to do with the order book. There will be prices at which you can buy and which you can sell. And where there are lots of buyers, it exhausts the liquidity on the buy side of the order book. And that's what pushes up the price.
All right, let's dig into that a little bit. So what is the order book? Is this just a list of everyone who wants to buy and sell a stock, how much they're looking to trade, and at what price they're willing to trade? Is it literally just that list?
Yeah, it is just a list. I'm willing to buy 50 million stocks of Tesla at this price. I'm willing to sell 50 million stocks of Tesla at this price.
That sounds more like it.
And then when the buying is out of proportion with the selling, then you exhaust liquidity on one side of the order book. And that's what moves the price.
So what's the price we actually see? We log into our app and it says, the price to buy one stock of Tesla is $350. What is that then? If we've got this order book where there's lots of people listing different prices they're willing to pay.
Yeah, it's called the mid-market price. And it's just so that you can plot something on a graph. What it actually hides is this incredibly complex structure of something called the order book. What you'll see is the mid-price between the best buying price and the best selling price. The buying price will be high, the selling price will be low, and you'll get an average plotted between the two. And the bid-offer spread, the difference between those two prices, will be pretty tight for something like Tesla, which is very liquid.
And I noticed that when you go to buy a stock and you push the button, until you get to that last stage, you don't actually know the price you're going to pay.
Yeah, I mean, you can do different types of orders. You can do limit orders where you specify the price at which you're willing to trade. But then what you sacrifice is the timing of the trade. If you do a market order, it goes in straight away at the best price they can find, either to buy or sell. But with a limit order, you can say, I'm only willing to buy at this price, kind of like a market maker. But then you may not get filled on your order. That's the drawback.
So what happens if there literally isn't anyone willing to buy a stock?
Well, that's when you see gapping of the market, because if it's a one-way market, that's the real problematic situation where no one really knows the price at that point, and price discovery kind of breaks for a short period of time.
But the market makers, who are meant to provide liquidity, do they not have to offer a price at which they're willing to buy?
Normally they do, but what you often see is that they'll reduce the sizes they're willing to offer. So the market becomes just immensely illiquid, or alternatively, they'll just put it at a crazy price, which is just miles above or below the price that it last traded at.
I'm willing to buy your stock for the princely sum of $0.
Well, you have to give some money in return. A cent.
Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.